The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman. Here is the Tiger Technicians Hour. My pleasure to be here Monday through Friday in market days. And what did we see? Well, first of all, we had some great shows this morning, and thank you to the hosts. And let's go straight to the Dow. Dow's up 13 at 16,506. I must tell you, it's an amazing thing. Last Thursday, on Wednesday, the Chapman wave trend gauge flashed a signal that said, tomorrow, usually it's in the morning, but tomorrow at some point, there should be a negative trade in the Dow. The futures were up 30-something points. The Dow was up 300 points, and it went down to negative. And then this morning, because yesterday it flashed the same signal, and the futures are up, the Dow was up almost 200 points, the S&P was up 19-20 points. I thought, oh, that is amazing. You can't just, there's no way that it could work. But you know what? The Dow went negative by a point after being up 160-something points. The high today was 16,664. In my comments to my subscribers this morning, I said the resistance should be in the 16,590s to the 1660s as an M formation continues higher. So we went right to the 16,660s and reversed, and the Dow is now up 10 at 16,500. The way these patterns work over and over, they just repeat. It's a fractal of human nature. There's just no other way to explain it. Let's just run the numbers. The Dow is up to at 1971. Let me just show you the charts at the same time. Right. First, I'm going to step back. I did Larry's show this morning. Larry's away. And we were right here, and I said that there's a good chance that the pattern we're looking at, you've got two fighting patterns. One is the cup formation, and the other is the arch. And I think the arch is going to win. And if it slides a little bit lower, it could take out the left side low of 1982.25, made at 7 o'clock this morning. If that does, it could go down. And then I drew a left side, right side price time match that said by 11:40, the 1975.50 level should be taken out. Well, we sliced through it, but basically what I was showing, because I'm not sure how many people from Larry's show know my work, Chapman Wave methodology of looking for peak Ds. Look, 1, 2, this is the 10-minute E-mini. 1, 2 Ds, pulls back sharply and starts brand new one, goes A, B, C, D. Can go to an E, which it did, pulls back, goes A, B, C, D. Can go to an F, which it did, pulls back, goes to D, and then an E, and it pulls back once again. So you had 8 peaks in that 10-minute chart, just from 2 o'clock this morning. Just from 10 o'clock, actually, there were enough. And that's the pattern that we always look for, a buy mode that goes to at least 4 peaks high to peak D. So a reason why I wanted to show you this, and it stopped where? Right on the 200-period moving average. We've had 1, 2, 3, 4, 5 bars that are suggesting that the 1968 level in the 200-period moving average should at least give a bounce. But having broken that level of 1975.50, remember, this is a trading, we love these shows to be both trading vehicles as well as explanatory and educational. So I'm doing this just to show you that there could be a bounce. Now, this is the candle that you need to try to see closely. 1969 was the low, and 1976.75 is the high of the bar of 22.11 this morning. That's the candle. The 9-period moving average of 1973.80. Well, it's the future, so we'll call it 1973.75. That's the level to pierce, and then you can make a little arch and then make another cup formation. We've at least accomplished everything that I wanted to see based on the Chapman Wave methodology of the trend gauge. So the day, I don't care where the day goes right now, except that we did, from our opening call subscribers, to go short pretty much at the opening this morning in the Dow. Okay. And it could be a short-term trade. I'm not sure yet whether it's going to be more than a short-term trade, but we'll see. So S&P, let me go to the S&P, SPX.X. So the S&P not there. Yeah. SPX there. It didn't go to a leg B, a big leg B. I went an AB within the M formation. That means that the very strong resistance now is going to be at, I want to get a relationship here. So this is the 120-minute chart. I'm going to pull the 120-minute chart down here for the moment and open these up so you can see everything that I'm doing. Okay, Chapman Roman candle monthly. That is serious stuff, because if the S&P starts trading at 1928 or lower for 3 out of 2 days in the weekly chart, the monthly chart will be impacted, and we will probably see in the month of September a test of the low that was made at 1867.01 on the 25th of August. All right? So the information's in place, but it's still active. 1960 is the tremendous 9-period moving average support on the S&P, and the high today, I'd say if on a rebound, the S&P can go to 1979, then there's a chance that over the next 2 days we could try for another test of the highs. All right, but in the meantime, the pattern is very familiar to us, being chart followers and chart pattern followers, and this is what I'm expecting in information. We'll see if that happens, or if it even breaks out to the upside. The QQQ series, because the comp index is up 11 at 48.22. Well, the QQQ right now has gone to a slightly higher high above the 106 round number high. It did go to the 106.31 area, and the 106.31 area says if it can get back to the 106.30s, I don't think it can, but if it does, then you can even expect the 107s to be broached over the coming few days. I'll talk about this particular volume. I'll talk about it now. This very sharp volume bar, a high spike volume with a low spike price, says that we could trade higher for another couple of weeks even, if in fact the 100 level on the QQQ is not taken out in the next week and a half. Because what this means is that there's enough power to the downside to give a rebound of time and not necessarily price. I'll be discussing that tomorrow in my webinar. Webinar called The Historical Context of Volatile Markets, a live event. Get a 30-day free trial to Basil Chapman's daily newsletter, the opening call, and attend this special live 60-minute webinar taking place Thursday, September the 10th at 6 p.m. Hey, together with that, I couldn't believe it. TFNN also has the Tiger Dollar sale this week. Up to 40% bonus on whatever you spend on Tiger Dollars. It's a fantastic thing. You got to make a purchase within 6 months. Now let's do this. You've got the comp index. I spoke about that. I want to look at gold, because gold right now is pulling back very sharply. It's down 12. I still see the same pattern that says arch failure, arch failure, arch failure. And I don't think we're going to get we'll get tradable rallies, but the real low I don't think will come in until I see a sign on that place that I always drive by that says gold sell and bought right here. Until I see a for rent on that place, I don't think we'll get a major buy signal. But regardless of that, what we're looking at is that the 9-period exponential moving average at 1124 is major resistance now in gold. Let's just say that the silver is down 0.07 at 1460. Is high-grade copper I'm following closely, because high-grade copper is in leg D. I think it's going to turn around here. I've got an alternate count in the 120-minute chart, but I'm going to be watching it closely, because at 2.439, up 0.005, if copper breaks 2.40 to 2.395, that support, then 2.36 is the 9-period moving average support. That's absolutely critical. I'm just wondering now if this isn't just a bounce in the weekly chart with more testing, but the low won't be taken out. We'll just go sideways for a while. We'll talk about that tomorrow maybe. Now, meantime, real quickly, the dollar, one of the reasons why gold is pulling back is that, why did that jump around? That the dollar right now is up at 96.13, up 14 cents. It's struggling to break out. It used up today and yesterday with too much time. It should have taken out the high of 96.62. So I'm suspecting that the dollar is still in a buy mode, but each time it pulls back sharply, it has a retracement rally and that rally is important to continue breaking to the upside, because if it goes sideways, it means that it's just using up time. It's not going to go that much higher right now, and it's not going to go that much lower. 95.17 is major support, a point lower. And boy, a break above 96.80, if that does hold, that'll be the first sign that says you go 1, 2, 3, 4 bars in the dollar and break to the upside. 1, 2, 3, today's the 4th bar, so it'll have to be 5 bars. But 136 is my pattern. And if you go up to 6 bars sideways, it usually says, yeah, you can go a little higher, but it's going to be a struggle because it keeps coming back to find support. The Nikkei, this is the Nikkei continuous contract. Lousy chart, good bounce, making the H to an M pattern. Monthly chart says, watch out. Weekly chart says, not very good. I think it could rally a bit, but then it's going to come back and break the lows. Let's go to Scott in Safety Harbor, Florida. Scott, how are you? Oh, did I just lose Scott?
Yes, sir. I am doing.
Oh, you're there. Hi, Scott. How are you?
Today. Everything's good. Obviously, I'm sure every time you see Gilead, you think about me.
Yep.
It's been just so good and such a sweet trading range, and I'm trying to make a lot of people money, but again, they never listen. You know, someone just called me and said, "Oh, I miss Gilead." You know, it went up to 106.40 today. All you have to do, people, is put a stop loss in at 106. Then it doesn't matter. You made your money. But people are so greedy, Basil, that they're afraid of that up and down movement. It might go down a little bit, then I get cashed out. Then I miss that big upside. Well, that doesn't work, folks.
Yeah, but there's something else that you got to understand, Scott, that you've developed a methodology, and you're sticking to that methodology. For somebody else, it's like when I used to, when I was a performer of the clarinet, I had my master's degree on clarinet from the New Conservatory of Music here in Boston. And I also used to teach. I taught for a really long time. And whenever I would teach, and then a student would look at me and say, is that how you wanted it? I look at them, and I always used to say, no. It's what you want. You're telling the story. I'm only giving you some guidance, and it takes a long time before anyone develops a technique, even if they use other people's influences to make it their own. So you've got to understand, you've got something that is your own, and if you impart that knowledge to others, they've got all their own baggage and stuff that they have to decipher, you know, what your implications are to them.
Everybody that eats the same meal, it's, I don't want to be graphic, but it's digested differently.
Right, it's the same, yeah.
Matter of fact, it could make some people sick, you know?
Yep. Now,
and
so let's look at Gilead. You see, I pulled I had it all written up, and I've been promising myself for months and months, years, not to change my opening call. Whatever I write in at the last minute, don't suddenly change it when you've been thinking about it. I'll talk about that. Can you hold on?
Yes, sir.
Go look at Gilead, and I'll be back with Scott in Safety Harbor, and I'll tell you a little story about what I...
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. We're on with Scott in Safety Harbor. It's Basil Chapman here. Tiger Technicians Hour. Dow's up 14, S&P's up 2. And I was just about to tell Scott that I had my opening call, my daily newsletter in my Traders Corner, which goes out at about 8:35 every morning. I start sending out my charts to my service around about 6:30 or 7 o'clock, and by 8:30 you got your 8:35 you got your final one, which is called the Traders Corner, and that's where we've got all our positions, and I give the stops and buy stops, any changes or what we want to get. And I promised myself so long ago that once I've done it, that is it. It's locked in. I cannot change it, regardless of what my feelings, emotional feelings are, as the 8:30 time, the clock is about to run out. And I, just before the bell, before the 8:30 time that I wanted to start sending my chart out, the Traders Corner, I changed one Dow short position. I made it a little lower, which meant that we didn't get it this morning. It was would have been a beautiful entry point. I had 200% short the IBB, just a fantastic entry. And I changed that. I said, we'll wait a day. And of course, those were two great positions to have gotten. I can't complain because we got a 300% short position, and that's working out quite nicely. But my point here is that methodology is methodology. When you start to change your thinking, it's not only dangerous, but what it does is it influences you to start to disobey your own rules. So you are stuck, you've got your rules, and you've benefited tremendously. So when you give advice, I think the one thing you have to keep in mind, as well as the people who are getting the advice, is that you have a knowledge base and you are not just arbitrarily throwing out something. You have thought it through. I just wanted to get that across, and you've stuck to it. So it's really important. But we're talking about Gilead, and what I wanted to say is that I believe that the IBB, the whole group, this move today, now it might not be the final move for the bounce, but the way that it turned around, the IBB is now down 4 when it was up pre-market about 3 points, having gone all the way to the 356 level. It's now 347. That's 8 points lower. I think that this is the one group, well, there are two groups, but this is the one group that's saying to me that it was spectacular on the way up. It involved all the other indices, and now it is part of the weakness that we see in the other indices. So your quick trades, I think that's the way to do it. You're working very well, and you keep getting back your cash. So that's really what I wanted to say, Scott.
Also, I'd like to look at Alcoa, but I just when you were on break, got a call from a friend of mine who's in Apple at that high price, the 130.32, and that's a good example. And I said, well, did you sell out today at the 113 high? No, I paid 130 for it. I paid.
Right.
They can't get it through their head.
No, Scott, you also have to realize that a lot of these people are not really traders per se.
They're investors.
They're people that get a position and they kind of get married to the position.
Yeah, boy, that's a good term. You're right, yeah.
And I think that you have to appreciate that
I like
makes
that.
it
We're
very
dating,
difficult.
And they're married. I like that a lot, yeah.
Yep. And when that's the case, then what happens
I'm
is
speed dating, by the way.
other alternatives to maybe getting out, getting back in, doing other things are really not there. They're looking at this as if it's got to come back, and I'll wait for it to come back. Not the right thinking in a bear market, which this is. So I do appreciate you calling. You wanted to look at Alcoa. We'll do that quickly.
Yeah, Alcoa.
Alcoa is a symbol. It's at 976. Just let me just give it a little bit of the parameters, then I'll hear what you say. And I just wanted to say, for clarification purposes and for just to articulate where we are long in my opening call. We're long from the 937 level, but this is leg D. It's taking a little time. I know you might have heard me when I said time is your friend on the upside and the downside. You want real quick consolidations, no more than 1 to 3 sessions, even if it's a 2-minute chart, and then you're onto the recovery high on the way down, unrecovery low. And in this particular instance, Alcoa weekly chart is saying I'm struggling at the 9-period moving average. And it's in leg D, and the 120-minute chart has given me as leg C. Oh, that's interesting, leg C. So there could be a little bit more to go. But what happens is I don't like the fact that it's gapped up yesterday and then closed kind of weak up, but weak on the candle, the Chapman Wave Roman candle. And today it made another recovery high, and now it's close to the lows. But the stochastic and MACD actually look quite good. So I'm watching it closely. I hope we can keep it a little longer. You wanted to say what?
I got in yesterday in Alcoa. I was actually happy about the pullback today, but and the way I've got it charted out, that pullback today is like a rubber band. It's going to pull back a little bit more, then we're going to snap back to, a 10, 50, 11 after that.
From your words to the chart's mouth. Thank you so much, Scott. I like that. Thanks for calling.
Thank you. Bye-bye.
That was Scott in Safety Harbor, Florida. I'll be right back. Dow's up 5, S&P's up 1. Whoa, what a day.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. The TFNN End of Summer Tiger Dollar Sale is here. We've just announced our best Tiger Dollar sale is back for 5 days only. This week, you can get up to a 40% bonus on whatever you spend when you purchase Tiger Dollars. Tiger Dollars are the best way to lock in added value and extra savings for any of your TFNN products or services. Normally, we only offer a 10, 15, or 20% bonus, but for this week only, we've doubled all our bonuses and are giving away 20, 30, and even 40% bonuses on all Tiger Dollar purchases. Tiger Dollars can be used for any TFNN product or service and never expire. So whether you're a subscriber already or planning on trying out a product soon, now is a perfect time to get your Tiger Dollars. For more information and to purchase your Tiger Dollars today, visit the front page of TFNN.com for all the details. Remember, this sale ends Sunday, so act now and don't miss out.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks, we're back. So I question about ACI, which is Arch Coal. If I said to you, there was a stock that just 7 years ago, back in 2008, was trading at 774, was it 774? 774, round number high, June of 2008, and has come down in price. What price? Come down quite sharply. What price would you think it was at? And you would probably say, well, 700, maybe 60, okay, and I'd say 60 what? And you say, well, $60, and I'd say, you mean 60 cents or $6? This stock went down to $1 in 2015, 7 years later. 7 years later. Hey, I would say that that's a problem. And I'm also beginning to think now, looking at that copper price and the others, I don't think the commodities are ready yet to make a big stance. I think that they're able to have bounces. They might not even take out the recent lows just yet. I think they will. But in the meantime, they could be just bouncing around. Now, coal is in the area that is just, this administration is just not interested in coal, okay? I mean, just face it. And if you've got that against you, there's a problem. If you were in something like solar, whatever, you'd have at least the benefit of perhaps getting resources and money from some kind of funding, outside funding rather than private funding. let's call it inside funding instead of outside funding. So I just don't see anything yet, and I think that at $4.33, up 35 cents, having hit the 200 period exponential moving average, it's a fantastic rally from one just this year in August, the 5th of August, it hit 1, and it rallied to $10.35. That's 100% gain. Wait, no, 10 times, yeah. So it's a tenfold increase. That is not bad. And now it's in the 4 area, underneath the 5 midpoint. So I'd say be careful. And if you are in it, don't get carried away. You can just have a little bit, but I would not hold too much of ACI. Percentage gains are great, but they're also great on the downside. After all, 10 to 4 is a bit of about a 60% decline. So I'm just saying, be real careful as a trading vehicle to bounce around. Let me look at the 120-minute chart. At this point, 3.40 is the 200-period moving average, and 4.68 is the 9-period moving. Excuse me. I've got an on-off switch. I'm just afraid to hit in case I forget to put it back on again. All right. So one sneeze later, and let's go on. So, bless you. Thank you. EMB was a question. EMB is trading at 107.89. This has got that same pattern. It's got the arch formation. It goes to A, peak A, B, C, D. Let me just do this in the weekly chart. Now, I'd be real careful about getting in right now, but if you're in already, that's a little bit different. If you're in from lower down, it gives you that cushion, and that cushion is really what I would say to anyone getting in right now. But it's a big percentage cushion, because I would say this, that if what is the EMB? It is the iShares, JP Morgan, USD, emerging market. Oh, okay, emerging market what? Emerging market bond ETF. Oh, okay. If that's the case, then it's debt. Oh, okay. Then I'm going to have to take a little bit of a deeper look at this. You see the chart right now. If you are looking at this chart and you look at that island reversal with that doji candle, this particular candle says that you should trade within the rectangle formation. It means if you break decisively out of that range, this is my own interpretation, up or down, you've got one bar out, because the very next bar that even just nibbles into the inside of the wick of that could go down to test the body of that candle. This one decided, no, I'm breaking out to an A and a B. But now you've taken 1, 2, 3, 4, 5, 6. You remember my rule of 1, 3, 6? And that says that in this particular instance, it's not good to be taking this amount of time to break out to the upside. Not that it can't be done. It's just that the stochastic is at 74%. The MACD is good. And yet the price has, from the time that it broke out there on the 31st of August to 108.46 to where it is right now at 107.90, the MACD has done beautifully. The stochastic is holding very well, but the price is fading. I'd be very careful of this. So this is EMB, iShares, JP Morgan, USD, emerging market bond ETF. It doesn't say it's going to break down. It just says that it could go sideways for a little longer. It could make the trading range between 106.50 and 108.70, maybe 109.10. And until it can really pierce 109.30 and hold there without pulling back at all, that would be the first time the weekly chart is showing that the 108.44 level is attainable and the 9-period moving average resistance. But I don't see it just yet. Maybe I'm wrong, but answer the question, I would not buy it right now. If I did, I'd only nibble at it, and I wouldn't even hang around if it broke 107.01, which is really not far away. I just wouldn't want to take it, because if it did that, it would be forming the arch formation, and that would weaken the weekly candle as well, let alone the monthly. But on the other hand, I'm totally wrong. I don't even understand this. iShares, JP Morgan, USD, emerging market bond ETF. Oh, it's just the dollar. Okay, it's the dollar related. Got it. Okay. All right, it's fine. It's holding the 200 period moving average of 106.22 in the monthly. I just don't see it yet as a buy, but I don't see it as a short. It's just kind of there. Okay. Hope I'm clear. It's just there. All right, there we go. Dow is down 14. So the Chapman wave methodology worked yet again at 98. I don't know what percentage. I'll be talking about it tomorrow, but only in reference to this particular chart here. And let me show you the chart that I'm looking at. This is where I got my indication for the trend gauge, Chapman wave trend gauge, but this is something that I'll be spending quite a bit of time on. Peak C1, peak C2 in the 120-minute Dow chart, and trough D. We're going to be talking about those Ds. We're going to talk about the relationship of the Ds. We're going to be talking about the relationship of the overall market and why my recommendation is that if people have long-term investments that they don't really want to touch per se, what they should be doing, seriously thinking about doing, and they have to take that chance of risk to reward because it's such an important period. And that to me is as important as talking about the volatility index and the historical context, etc. What can we do to protect our money is part of what I'm talking about tomorrow in my webinar. And that webinar comes across at 6 o'clock right there. The historical context of volatile markets, a live event. Get a 30-day free trial to Basil Chapman's daily newsletter, the opening call as well. I think that's a nice deal. All right, now let's look at what I was talking about before. The Dow Quartet, GE, breaks to a new recovery high, pulls back 6 cents to 24.90. If GE at any point breaks 24.50 support in the next 3 days, that's just going to be a tip-off to say we're actually pretty much done with the rally. So far, it says there's a little bit more strength. That's why support could come in. That's the reason why we could last maybe even another week just chopping around in this area. Volatile market, up and down, but this is nothing in the context of where we've been in terms of the history of the volatility index. Now let's look at the IBM chart. IBM, there again, big pop-up and a sudden turnaround to the downside. That sudden turnaround to the downside is suggesting that the weekly chart of IBM is so weak. The WEK chart of IBM is so, WEAK, that rallies are there just to see fund managers get out or to reshort. That's the way it looks. And until IBM at 147, down 17 cents, can break above 153, I mean, that's not far away for IBM. It shouldn't be, but it is. It's 7 points. You get to that 153, 154 area, all of a sudden you're looking at a chart that says, thank goodness the monthly is beginning to show a positive divergence. It is already, but it isn't working because the stochastic is way better than it was in January, and yet the price is way lower than it was. So that should be a positive divergence. Turns out because of the MACD deflecting lower that it's a negative divergence. Look at Triple M. Triple M, big spike to the upside today, pulls back. Now it's down. Weekly chart, not a great pattern. Monthly chart, horrible pattern. UTX pops to a recovery high, leg B. Now it seems to be pulling back. Weekly chart, lousy candle, doji candle, last week. Just breaks above the candle of the 24th, the 28th, the week of the 28th of August. Hasn't held it yet. Monthly chart says, oh man, there's a real good chance we're going to be testing the 87 level, the low. And if it breaks, that's going to be a big negative. So overall, the more I looked at stocks, the more I looked at some of those IBD stocks, the ones that were AMBA. These are stocks that were screaming to the upside. Just on the 24th of July, Ambarella was at 129.19, peak D in the weekly, peak G/C in the monthly, and now it's at 70. I would say that a 40-point decline, more than a 50% decline, is not good. And that was one of the leading stocks. If that's the case, then we have to be saying this is a market PA&W, question in the den. Yep, sure. PA&W, same pattern, that arch pattern that goes from an H to a lowercase m. Weekly chart, terrible. Strong resistance at 170.39, trading at 167.21, up 68 cents today. Palo Alto Networks Inc., Internet Security. I think this is a D in the monthly. But until it breaks 155, I have to say this still could be a bounce. But I think it's done on the upside. I think most of these stocks are making hat-trick tops. I think they are in for a far serious decline in time. And in price, you've already come back in Palo Alto from an all-time high of 200.55 just back in July. And you've traded down to the August 24th low of 140. I would say 60 points is pretty serious. So for me, for some stocks, I think a chunk of their decline is done. Now they have to do the retesting phase. So for them, it's the internal low might have been made. Now we're waiting for the residual low. Question in the den. Basil, can you look at the VIX chart if you haven't already? Here's the VIX chart. Well, of course, tomorrow night, I'll be spending a lot of time on all the different VIX charts. But right now, it's at 24.41. Now, the reason why it's still down 0.49 is that the deflation, boy, you talk about deflation, the balloon deflation right here. From peak C at 53.29, it went to a low today of 21.51. So that's more than a 50% decline. And the key support is at 21.06. And I was waiting actually to buy the volatility index closer towards that 21 area than the mid-22s. I don't know if I'll even get it, but that's what I'm looking at, and I'm going to be discussing. So the VIX index right now has a failure pattern. It's gone to a leg A, B, C. This is a leg C, A, B, C, D to the, no, do it again. A, B, C to the downside. Let me just type that in. A, B, C. And my thinking here with the MACD and stochastic still negative is the chop phase is still in place. That, in fact, it should, because of the failure pattern, it should be a little higher. It should be closer to the 9-period moving average of 26.18. But, in fact, what we're looking at here is that the weekly chart, the plunge in the weekly chart is so severe, and the breaking of this long-legged doji to the downside is suggesting to me one bar outside, not the close, but the bar itself, making next week's candle very important, because there could be one more candle underneath the body of this weekly candle. That means the open of 1432 and the close of, wrong candle, the body, the open of 2703 and the close of 2780. So let's say that the mid-27s, that's the thing that has to be retested at some point. It might take 2 weeks before you can get back there. I don't know, but I'm suspicious of moves like this under the conditions that we're looking at. Why? Because the bounce from the August 24th low, the August 24th high in the VIX at 53.29, should have pulled the VIX back into the teens. It should be below, it should be between 19 and 17 with a 16.21 200-period moving average, the major support. So the fact that it's holding quite high here says to me, be careful, because there is still fund manager buying of safety. And that's the thing that's important. If it remains quite high, we'll be talking about that when I get.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Hi, folks. We're back. Basil Chapman. Dow's down 7, S&P's down 0.46. So we got that negativity. Tiffany, how come Tiffany has gone from November's high of 110.60 down to where we are today at 82? Huh? If things are so great. I think that this is telling us a lot. If you look at the RTH, and I'll be looking at some of these indices tomorrow, what I will do, I don't know if I can do it right now. Let me do this here. So the retail index, which includes Walmart, Home Depot, Amazon, CVS, Lowe's, Costco, McKesson, Target, TJ Maxx, just goes on and on and on, is holding okay. And it went from 78.56 to, I don't know who traded it at 66.66 yesterday on the 24th, but it had a spectacular decline. My thinking is it's going to take time now to come to the downside, but it will be downside activity we're looking at within a week or two. You'll take out at 75, 78, you'll take out the 72 support and start pushing lower. And the patterns, when I looked over the last 5 days, when I've been looking at the monthly patterns, together with the weekly patterns, it suggests to me that this very large pattern that we're looking at in the Dow, I'm going to squeeze this a little bit so that you can see what I'm talking about. This arch formation, that arch formation is telling me that there's been huge distribution and that the price, I keep getting emails about crashes. I don't see a crash. I might be wrong in the price eventually going down, but I don't see a crash per se. I just see a series of lower lows and lower highs. You might have 2 internal lows and 2 residual lows. All I'm saying is that the patterns I'm looking at here suggest that there is no comparison at all to the crash chart formations. The result in the end might be the same, but you're not going to get those 3 days of just a cascade to the downside like we saw in the 1,000-point drop, except it'll be a 3,000-point drop. So this arch formation tells me that there's been distribution, and as such, we had to wait patiently for each sector. Hopefully, we did nail this morning one of the sectors that we got a fabulous entry before. We got a little profit, but I don't want. I'm being very gingerly about getting into the short side. We've done it again today. And I think that this is one of the last sectors that's going to be coming down very sharply. It's not what I'm showing here. It's a different one. So the RTH is in that category that says, now we can take our time by filling in the wick. That's really what it's saying. Upside limited, downside not yet limited, and going from 75 to 66 back again, or even if it goes from an internal low to a residual low to 70, that's still a big percentage pullback. We're going to watch this one closely. So as we're about to sign off, what's today? Wednesday. I'll be back tomorrow. I'll also be doing Larry's show tomorrow. And tomorrow night, I'll be doing my webinar. Once again, let me show it because I think it's such an important period for it. Look, it is the historical context of volatile markets. And what I'm going to show is, if I can do this, just get out of that one there. Is that a mistake? Yeah. This is the chart I'm going to be looking at. Remember, I showed this back at the beginning of the year. I said we're in wave 3. In Elliott, in the Chapman wave, it's a different notation, but it coincides so beautifully that I'm expecting a sharp pullback, and I drew that line, not down as far. I just drew it down to say wave 3 in Elliott is coming, and that implies that we should get a leg 5 to the upside. If that's going to come about, a lot depends on where we stop and how we stop on the downside. So I'm going to be talking about that in great detail. And that has to obviously do exactly with volatility historically, where we are, what portends, what am I expecting, and in that particular context, let me just put it to you this way, that there are other volatility indexes, the VIX, there's the VXO, that's the classical one, and that's the one that I want to show you something fascinating. And the Dow in 1987 went to, let me just quickly do this, 1987 went to 172.79. It's trading at 24 right now. I'll be talking about all of that in the webinar coming up tomorrow night. Check it out. Thanks for being here. Stay tuned for Daryl.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.